Hello friends, let us see insider trading in this part. This insider trading is related to share market and share transactions. On the secondary market, the shares are purchased and sold by the shareholders. And the main purpose of buying and selling of shares is to earn the profit or to minimize the loss. So the shareholders get the information about the company, about the performance of the company, about the profit of the company, about the future of the company, and on the basis of that information they decide whether a share is to be purchased or the holding is to be offloaded. The information regarding the performance of the company, any event that has taken place relating to the company, or any decision of the company, board of directors, will definitely affect the share prices. And hence people are curious to know the information or the event or the decisions. And the company is required to disclose this. They have to publish it, they have to make the announcements, and once that is done, people come to know the changes that are going to take place. And on the basis of that, the shareholders take the decision of buying that share or selling that share, of course, with the objective of earning the profit or reducing the loss. Now, this information may be related to different things. Like, for example, it may be related to the profit of the company. It may be related to the rate of dividend that the company is going to declare. It may be related to bonus issue announcement, right issue announcement, further issuing of shares. It may be relating to buying back of shares, or it may be related to merger and acquisition of the company, or it may be related to any penalty which is imposed by the government on the company. Different types of information may be there. And all this, when made public, when published, then people, the shareholders at large, will come to know. But there are certain persons related to the company who can know this information or the decision or the event even before its announcement or even before its publication. Who can be such persons? Like the directors who take the decisions. For example, how much dividend is to be declared, whether right issue is to be given or not. That is decided by the directors. Directors decide it first in the meeting and then they announce it. So few people like directors or those who are holding good position in the company, position at a very top level, may also know this information. Some employees who are related to, for example, finance, related to marketing, related to production, may get this information earlier. And I said information, events and decisions. There may be a person holding substantial shares, or there may be people from R&D who have developed some new product and they are going to launch it. People at large may not know that this new product is developed, but that person from R&D knows this, knows the policy of the company also, when it will be launched, what will be the profitability of it. Some of the brokers of the company, bankers of the company, lawyers of the company are some persons, examples of persons who can know the information in advance before this information is published. So I have stated two things. Some information is sensitive, which is going to change the share price in the market. And second, there are certain persons who are called as insiders who can get this information in advance. So these insiders, that is the persons who can get the information, who know the decisions in advance, they trade on the basis of this information which is not available to the people at large. So they take the advantage of their information that they get in advance. They trade on the basis of that and earn profit, or they try to reduce their loss by selling the shares. People will come to know afterwards, and before they take the decision of buying or selling the shares, these people, the insiders, they sell the shares, minimize the loss, or they buy the shares to maximize the profits. This, in short, is called as insider trading, and those who do this insider trading, they are called as insider traders. Needless to say that this is unethical. Because of your position, if you know some information, if you know some decision in advance, well, you should not make use of it for minting the money for yourself at the cost of all shareholders and investors in the company. Hence, in almost all the countries, almost all the stock exchanges, this insider trading is illegal and it is liable for penalties. It is liable for legal action. Even though it is so, it becomes very difficult to prove that insider trading has taken place, because the person getting this type of inside information may not deal in the shares directly in his name. He can buy or sell the shares in the name of somebody else and can get the benefit of change in the prices. This is, in short, insider trading. That's all for this episode. Let us meet in the next episode with some other concept. Thank you and goodbye.